Money. Money.
Tina Mitchell here with your Money Chat. The Fed has been buying $120 billion each month, including $40 billion of mortgage bonds and $80 billion of treasuries in order to inject liquidity into the markets and to keep long-term rates low to promote borrowing and expansion. On Wednesday, the Feds said that they would start reducing that amount by $15 billion in November and $15 billion in December. The breakdown is $5 billion reduction in mortgage-backed securities and $10 billion reduction in treasuries. While I fully expected this announcement, I thought that they would wait until December, but they said that they may change the amount of the taper in future months, either more or less, depending on the economic conditions. If the Fed were to continue to reduce their purchases by $15 billion per month, they would still be done with their outright purchases. They'd be completed with them in June of 2022. But over that time, they would still have bought an additional $500 billion in mortgage-backed securities and treasuries. For perspective, the total amount that they bought during QE1 and QE2 during the Great Recession, during the financial meltdown of 2008, was $600 billion each time, so that they are still going to be buying a ton more. Even with tapering, the Fed's balance sheet will increase from 8.5 trillion to 9 trillion, which is a staggering number. Additionally, the Fed said that they have not even talked about the reducing their balance sheet and stopping the reinvestments. The Feds hold mortgage bonds and treasury, which means that they receive principal payments for those holdings, which they normally would reduce their amount of their balance sheet over time. Some of those securities would naturally mature as well, but the Fed has been taking all of those proceeds and reinvesting them back in to mortgage bonds, which has prevented their balance sheet from getting smaller at all. Those reinvestments amount to a massive additional $60 billion per month. So even when they stop their outright purchase by June, they're still going to remain quite accommodative until they start allowing their balance sheet to reduce over time. Now, this was all well telegraphed, but the big question is when the Fed will start hiking rates. The Fed has two mandates: stable prices and maximize employment. Some would argue that they also have a third mandate, which would be higher stock prices. Now, regarding inflation, the Fed changed their language and said that the inflation was elevated, but reflecting factors that are expected to be transitory. They changed the language to reflect that there is a lot of uncertainty regarding inflation. Basically, they're hoping that the supply chain bottlenecks ease and that causes inflation to move lower. The real thing that the Fed could do to curb inflation would be to hike rates. But Powell said during his talk that he does not want to suppress the demand side on the economy and hike rates until the labor markets heal further. Bottom line, Powell did not give an indication of the rate hike, and it's expected that we will see the first one sometime during the latter part of 2022. Now, a rate hike would most likely be great for mortgage interest rates, as it would most likely improve inflation. It's important to understand the difference between the Fed's fund rate, the prime rate, and mortgage interest rates. When the Feds hike rates, it is a direct impact on the Fed's fund rate and the prime rate, but not mortgage rates. The Fed's fund rate is the interest rate that banks charge each other to lend Federal Reserve funds overnight. Now, the prime rate is based on the Fed's fund rate and is used to determine the cost banks will lend to consumers for short-term loans like credit cards, car loans, home equity lines of credit, personal lines of credit. These are all impacted by prime increasing or decreasing. Mortgage rates are not directly tied to the Fed's fund or to the prime rate. They are directly tied to the Fannie Mae 30-year bond. We will likely continue to see mortgage rates increase as inflation is on the rise. Inflation is the arch enemy to the bond market, which then arch enemy to mortgage interest rates. When bonds drop in trading price, mortgage rates will increase. A good indicator for inflation is the consumer price index and the produce price index. The CPI, consumer price index, is the cost to consumers for goods that they pay at the store. The PPI, producer price index is the cost wholesalers pay for their parts. Now, PPI goes up, wholesale prices go up. They make less or pass that on to the consumer. A higher CPI and PPI means inflation, and that is bad for mortgage interest rates. On a positive note, homeowners benefit from inflation because the money that they pay back, their fixed mortgage payment is worth less today than it was yesterday, but it's fixed. The higher the inflation rate, the sooner your home value doubles based on the rule of 72. Also, home prices usually rise with inflation. As the value of the dollar is worth less due to the higher inflation, it will take more dollars to purchase that same property. Real estate has traditionally worked well as a hedge against inflation. Your home's increasing value will offset some or all of the inflation. There are only a handful of hedges against inflation: real estate, gold, assets that will inflate at the cost of everything else going up. And so a call to action is, if you are not in the real estate market, now's the time to get in. Again, real estate favors well with inflation. Mortgage interest rates most likely will continue to go up. And so get out there and take a look at homes. And what a great way to segment in to our first guest, because we're going to be talking about the real estate market. And that is your Money Chat.